RBI Governor has been repeatedly advising banks, NBFCs and Fintechs publicly about the steaming growth in unsecured loans. If you recall, Deputy Governor J.Swaminathan at the Monetary Policy press conference gave the numbers. Unsecured credit has been growing at 23% over the last couple of years versus other verticals which are growing at 12 to 14%, he said. Separately, data from CIBIL points out that NPAs in the category of loans less than 50,000 rupees, small loans, has jumped to 5.4% as of June 2023 from 4.2% year ago. Also, the number of persons with 4 loans in this category has jumped very sharply. So, how serious is the unsecured loan problem that the governor is raising it repeatedly? We have with us Sitaraman, Senior Director and Chief Ratings Officer at Crisil Ratings, Soumya Kanti Ghosh, Group Chief Economic Advisor, State Bank of India, and Jairam Sridharan, Managing Director at Piramal Capital and Housing Finance. Gentlemen, thank you very much for your time. Jairam, you raised the flag some time back. The numbers are still not telling us too much. But are your worries greater now about unsecured loans?
Firstly, Latha, thank you for having us. I would say the worries are about at the same level as when I last spoke with you maybe 4 or 5 months ago. I think there is more data now that gives more credence to what we have been thinking about. What we see today is that in the smaller ticket unsecured, risk has clearly started showing. 4 or 5 months ago, this was speculative. Now it is fact. You presented the information on less than 50,000 rupee unsecured loans and how the risk on that has increased a lot. If you go even further down, Latha, the risk has actually gone even further high. So less than 25,000 rupee loans are actually even higher risk. Less than 10,000 rupee loans are even higher risk than that. So essentially, the smaller you go, the higher the risk has gotten. Now, of course, it's expected that small ticket loans will be high risk. So that's not the issue here. The risk is in absolute terms high. The risk is that it has the worry is that it has increased. In the less than 25,000 rupee category, risk today is about 70% higher than what it was 6 months ago. So that's the kind of increase that we have seen. These are small numbers in terms of overall portfolio size for the industry. In rupee, in lakhs of crores kind of terms. But still, the fact that a part of the business has increased risk 70% is seriously a cause of concern.
Yeah. Actually, CIBIL shared some numbers because I wrote to them. So this was a reply from CIBIL. They pointed out that the amount of loans which are under this 50,000 category form 0.3% of the total retail loans. Now, total retail loans, according to their previous data, is 90 lakh crore. I think that's as of June. So 0.3% of 90 lakh crore works out to about 27,000 crore. That, even if the whole thing went bad for the banking system, it doesn't look like a very big number. Soumya, your recent report seemed to say that this is not a very big threat. What are your arguments?
Yeah, thank you, Latha. I think that while the concerns on this is well appreciated, I think numbers do not suggest any alarm as of now, because if you just purely go by the bank credit data, the breakup of unsecured and secured credit, you will find that the compositional shift towards unsecured is actually not correct. It is continuing at 10%. The second important thing is that we recently also did a study of NTC and NTCC. Basically, NTC means those are new to cards. We wanted to see that whether the other unsecured portfolio of credit cards is also doing well. We actually found out that the borrowers who are in the NTC category, basically new to credit, and these are the borrowers of the small borrowers, actually their behavior mimics a similar behavior of the NTCC customers. So that means that the alarm over the change in a behavior of the small ticket loans is as of now not exactly warranted. And the other important thing which we found out from the data, and it basically shows that the origination standards, I think the unsecured and secured both have expanded from COVID. If you take the data from 21, both have expanded, and that clearly shows in the data. But the important point to you that recently in the RBI Financial Stability Report also, and as you correctly pointed out, it's 0.3% and 98% of the overall loans is more than 50,000 crore. And in the recent Financial Stability Report, one of the important data points which shows that the net shift in the borrowers from one category to other in terms of the better rated was much higher across the upper rated borrowers, basically the prime rated borrowers. And the second thing is that the origination standards, the risk origination numbers, which was last available for March 2023, that shows a significant upturn for the prime borrowers across all banks, including public sector banks, private sector banks, and industry. So the point which I'm trying to say is that if the origination standards recently of March 23 is actually showing a significant decline, and given that most of these loans, unsecured loans, are of shorter duration, that means that if there was any alarm, that should have started to happen much earlier, because the housing loan, which is a secured part, is around 51% of the loan, and this share is around 20 to 20% overall. So in my sense, I think while there may be pockets of some sort of an increase in the asset quality or some concerns on the asset quality, I think overall the numbers suggest that the share of the subprime borrowers in the overall category, as per the recent RBI data, has been on a continuous declining trend.
Okay. Well, actually, as you speak, we have put out the data on the portfolio share, and the portfolio share of loans under 50,000 is only 0.3, as I just pointed out. And just to Soumya's report pointed out that new to credit, that is people who are taking loans for the first time, that proportion has fallen from 13.4% in March of 22 to 8% in March of 23. He also points out that subprime loans have fallen, near prime loans have risen, prime loans, prime plus super prime, which are all good categories, all those loans have risen from March of 22 to March of 23, saying that there is no secular trend of poorer quality loans. Now, Krishnan, you have an unenviable task. Jairam was the first to point out that he's scared of unsecured loans. Soumya Kanti thinks it's not. You tell us, I mean, I'm assuming you're the middle ground. What is the Crisil data saying?
First of all, very good morning, everyone. Thanks, Latha, for having the show again. I would say at the outset, I share what Jairam said as well as Soumya said in their own context. Let me start with a slightly big picture view. If I look at the last 2 years or so, how retail has evolved in the banking system, NPAs have actually come down from around 2.1% to 1.4% overall for the retail segment as far as GNPA goes, March 21 to March 23. Within that, if I look at unsecured, there again, the NPAs have actually come down. They've come down from 3.2% to 2% overall NPAs. Then if I do a little more of a drill down, and look at the SMA1 and SMA2 accounts, which are essentially 30 to 60-day overdue and 60 to 90-day overdue, potential candidates for slipping into NPA, they are currently not NPA. So those numbers have also come down for the unsecured segment from 4.2% to 2.3% over the 2-year time frame. Now, that said, if we look at the unsecured portfolio, I think we can split it into certain categories. As you rightly point out, one is the less than 50,000 rupee ticket size. Then we have the 50 to 8 lakh tickets, as I would put it that way. And larger than 8 lakh, I would say, is the large ticket personal loans. If you look at each of these categories, if I see the large ticket category, more than 8 lakhs, I think there, again, the numbers are quite steady and the delinquencies are quite under control. Where we have seen some uptick among some of the players is in the less than 50,000 category in the ticket size, less than 50,000. And we have seen delinquencies and NPAs move up there. And when I look at it in totality, fundamental factors, I would want to look at the III effect. III stands for 3 I's, that is interest rate, inflation, and indebtedness levels. So if we look at these 3 factors, if these 3 factors go up, then that puts stress on the repayment capabilities of financially vulnerable customer segment, which is essentially the customer segment for the less than 50,000 category. Now, you talked about 0.3%. Now, when we look at retail, our numbers around 13.5 odd lakh crores for the banks and NBFCs put together. Banking sector roughly 10.5 lakh crores, close to 3 lakh crores for the NBFC segment, and the unsecured space, probably the 90 lakh crores include some of the SME loans as well. I am looking at pure retail. Now, when I look at that, the sub 50,000 portion is not, less than 2% of that mix. It's still not a very large quantum. Yes, while we see some upticks in the delinquencies that we are seeing in the sub 50,000 segment, that still is not a very large proportion. I am not sure there is any cause for systemic alarm. But if I look at certain players, there would be certain players in the NBFC segment who would be focusing on the less than 50,000 segment. Okay. And I agree with Jairam when he says that as you go lower in the ticket size front, the challenges will go up because the financial vulnerability of that customer segment goes up. If we go back to, say, the demonetization challenges or other challenges like the microfinance crisis of 2010, and even during the time of the COVID, when we had the lockdown, we saw the more vulnerable segments get impacted more. So they are susceptible to the vagaries of the economic landscape. So we need to monitor that situation, part more closely.
Okay. I'll come back to Soumya on this, but Jairam, very quickly, the fact that the Reserve Bank has not imposed any risk weights or provisions, very clearly Governor and DG said it is only advisory. They know something, isn't it? So one need not worry so much.
The regulator certainly knows more than most of us. They have seen all the data in the system. So the fact that they have not taken any action, while it's a little bit surprising to me, I will defer to their better judgment on this point. See, one or two points separately I'd make though, Latha. This fact that it's a small part of the population when looked at in rupee crore terms is misleading. If you think about the fact that when you do NPA recognition in any bank or NBFC, you have to do NPA recognition at the customer level, not at the account level. So if a customer actually goes bad, all the customer's other loans also go bad. So what you need to look at in this case is number of people. How many people are there in this population, and you will find that in number of account terms, this is a much larger population than people are imagining. And when any of these guys goes bad, if this guy also has a credit card running or an auto loan running or two-wheeler loan running, all that will also become NPA simultaneously. Second point I'd make is that this reliance on bureau scores, etc., can bite you in the backside. Like we have seen it in prior credit cycles as well. When a cycle turns, the bureau scores don't catch it. Bureau scores catch up after the turn has happened. After the guys have gone bad, bureau scores start turning bad. The guy looks good, and then he turns bad all of a sudden. And after he turns bad, his score starts deteriorating. So looking at the scores as if it is a forward-looking view is not appropriate. It is not a forward-looking, not on turns. It's a very.
I take your point. It may at best tell you whom you should not give a loan, but the credit score does not tell you that if I gave the loan, it will definitely be good. It will clearly tell you who is bad because the score is...
Especially on turns, shows, when the economy is turning, the bureaus fail.
I agree. That's the point I want to ask you, Soumya. While I agree with you that the numbers look very good right now, you have even given numbers of all the banks who have reported NPA numbers. Everybody is showing a fall in NPA numbers. But if the cycle turns, for instance, already IT companies are reducing their headcount. I mean, they have not fired, but clearly they are not hiring. And the startup community even fired people. We are heading for a global downturn, probably looking at the way the US yields have risen. What if all those big employers were to take off some people in India? So do you think if this growth falters, we have a problem, Soumya?
Latha, I think this is a very important point we have raised, but I would just like to mention two other things. I think the approval rate of these NTC borrowers have also significantly fallen over the last 2 years. And other metrics, I think, and credit card, actually the scores of these borrowers change every month. And the point which I raised in the beginning, that if the cycle turns suddenly, there could be a problem. But in my sense, since most of these loans are demand loans, often shorter duration of interest, the rate of interest is higher, the prepayment option of the borrowers is also on the higher side. This is basically a common trend. So therefore, if the origination of these borrowers goes down in the portfolio, that means in the next 1 or 2 years, it will only reflect better on the asset quality of the banks, even if assuming hypothetically that it was not good at the beginning. But my sense is that as of today, while there could be always some pockets of some disturbances, and please note that we are actually getting into a new structural edifice when these borrowers at the bottom of the pyramid are actually getting integrated into the banking system. That's why you are getting a consistently credit growth of 14 to 15%, and the nominal GDP is less than 10%. And one important data point finally, which I'd like to point out, that if you look into the credit card portfolio, because as of today, the credit card is the most preferred option, because in terms of the EMI, you can pay in say 6 or 10 EMIs without any interest. That in nominal terms and real terms have significantly declined from January 2023 as in August 2023. So I will again repeat that as of now, the banks can obviously monitor the portfolio in terms of better underwriting and standards which they have built on over the last couple of years before pandemic and after pandemic. But as of now, there should not be a cause for worry as such, because all numbers as of today are showing a decline. This could again have some irrespective increase in here and there some pockets, but because all borrowers are not uniform. But to us, I think it's too early to say anything on this one.
I take your point that at the moment the gross numbers do not cause any systemic worry, but I think the regulator is right in pointing out that this may be a worry for tomorrow. I'll leave you all with only one point I picked up from the banking sector. Sources tell me that there are some banks which are giving personal loans for 7 years. Personal loans were given for 1 year, 3 years. There has been a tendency to extend that to 7 years because the salary account is with us. But who is to say that person won't resign or won't lose his job? So there are fears over there, and perhaps the regulator is right. Well, on that note, we have to wrap up this discussion on Bazaar with the news that the market has actually dipped below the 18,900 mark. So back to stocks when Chartbusters starts after a brief break.